If anybody wants a copy of the slide, just shoot me an email and I can send you over a copy of the presentation as well after the fact, so to speak. So with regards to credit repair, and credit score boosting, there is a law called the Fair Credit Reporting Act that kind of is the rules or the guidelines with regards to how the credit bureaus are governed. And it's important that we kind of start off with that. The one thing that I'll tell you is right now is the best time in my whole career to help clients get their credit score boosted. And the reason for that is because of the virus. This Fair Credit Reporting Act, I'll give you the short abbreviated version of it. It's basically the best practices that are by law that the credit bureaus have to utilize. And the main rule in there is that from the time somebody would dispute any type of trade line, any negative trade line on their credit report, the credit bureau, whether it's TransUnion, Equifax, or Experian, they have a limited time frame to explore that dispute and get it resolved. And that time frame is 30 days. So if I am, let's say, disputing a claim on my Sears bill, and I'm disputing it with TransUnion, I send a dispute letter to TransUnion, they review it, and then they send it off to Sears. Sears has time to investigate it, and then they have to get their results back to TransUnion, and all that has to occur within a 30-day period of time. Well, 30 days, it would seem, in most people's mind, is a significant amount of time. However, before this virus hit, they were having a difficult time staying up with the 30 days prior to the virus. Now with the virus hitting and employees getting their hours cut, employees maybe getting laid off or working from home, and they don't have the same systems available at home as they would at the office, I just don't see that there's any way in the world that they're going to be able to keep up with the 30-day time requirement. So if you have any clients with derogatory credit, anything that they need to try to get removed, I'm telling you right now is the best time in the world to try to get those items removed. The company that I utilize for credit disputes is a company called National Credit Care, and they're actually out of Inglewood, Colorado. I've been doing business with them for over 10 years, and I've had my own family members enrolled in the program. I'll give you a quick example. My knucklehead son decided for whatever reason to stop paying on his student loans, and they got behind. And then 6 months later, he decides he's going to get married and they want to buy a house, but he's not in a position credit-wise in order to buy a house. So he comes to me, we enroll him in the program at National Credit Care, and 6 months later, we were able to put him in a house. So it can happen, and it does happen, and it happens every day. Consumer reports. So commonly referred to as credit reports, a consumer report contains information about your credit and or some bill repayment history and the status of your credit accounts. This information includes how often you make your payments on time, how much credit you have, and how much credit you have available. The key there is credit availability. That has a 30% weighting on your total credit score, and we'll get into that here in a minute. How much credit are you using, and whether a debt or bill is a collection account on money you owe. It also can contain public records such as liens, judgments, and bankruptcies that provide insight into your financial status and obligations. Okay, inaccuracies on consumer reports. In a 2015 study released by the Federal Trade Commission, it found that 23% of consumers identified inaccurate information in their credit reports. And I would tell you that it's probably a higher number. It's probably closer to 35% with regards to inaccuracies. Accurately reflecting credit transactions amended to the FCRA, the Fair Credit Reporting Act, passed in 2003. Consumers have the right to receive a free copy of their consumer report, and they can go to freecreditreport.com and get a copy of it. You're allowed to get a free copy of your credit report one time a year, and I would recommend that everybody do that. Now, one of the things that I do with your clients that you send to me is we do not have an application charge. We don't have a fee at all. Some lenders will charge between $200 and $300 for the client to apply for a mortgage. We don't have that, and we will also provide for free to the buyer a copy of their credit report. And we're going to give them a tri-merge credit report, which has all of the information on there from all three of the repositories. So it'll have information on there from Equifax, TransUnion, and Experian. And it's a mortgage credit report. Now, one of the things that I have asked and kind of try to educate folks on is whenever you're dealing with somebody and they're in the early stages of buying a home, they want to get with somebody like me probably at least 6 months ahead of time so that we can take an application and pull their credit report so that if there are some goofy things that are on there or stuff that shouldn't be on there, that gives us time to get them cleaned up and put them in a better position to not only get approved, but to get a better interest rate. So remember, about 6 months ahead of time, have them call me, let me take an application, pull their credit report. Some people think, oh, they don't want to have their credit pulled because their score is going to drop 100 points. That's not an accurate statement either. The actual number is 4 points. It'll be a 4-point hit for what is known as a hard credit report pull. A hard pull is when a lender pulls the report. When the individual as a consumer pulls their own credit report, that is called a soft pull, and that has no effect on the credit score at all. However, a consumer can't pull a mortgage credit report, and that's truly what they want to look at and review. There are about over 10 or 11 different types of credit reports. There's a credit report that the mortgage companies use. There's another one that the automobile industry uses. There's another one that the credit card companies use. There's another one that the utility companies use. There's another one for cell phone companies. There's another one for insurance companies, and they all have a different algorithm. In other words, a different scoring methodology. And the points are different. So that's why we want them to get in touch with me. I'm going to pull a mortgage credit report and see if there's anything on there that's going to affect it. The higher the credit score that we can obtain for one of your clients, typically the more money that we can get them approved for and the better interest rate that we can provide to them. So that's some of the things that we want to do, ahead of time. Furnishers of information. A creditor is a company that furnishes info to the consumer reporting agency, such as a bank, mortgage company, credit cards, courts, that type of thing. Hang on a minute. I'm going to move this over a little bit. Number one there, provide complete and accurate information to the credit reporting agencies. 2, investigate consumer disputes received from the credit reporting agencies. Correct, delete, or verify information within a 30-day receipt of a dispute. Inform consumers about negative information which is in the process of or has already been placed on their report. Consumer reporting agencies, CRAs. Consumer reporting agencies are entities that collect and disseminate information about consumers to be used for credit evaluation and certain other purposes, including employment. Credit bureaus, a type of consumer reporting agency, holds a consumer's credit report in their database. The big three, the ones that you guys are all familiar with and heard of, would be Experian, TransUnion, and Equifax. Those are the 3 big CRAs. These are the companies that when we, as a mortgage company, pull the credit report, these are the companies that we are pulling. When we pull the credit scores from these credit repository companies, by guideline, most of the government loan programs, Fannie Mae, Freddie Mac, that type of thing, we're going to get a total of 3 scores. They're going to use the middle score of the 3. If there are 2 people on the loan, they're going to use the lower of the middle score. So in other words, if you got a husband and wife situation, and he's got a 700, a 750, and an 800, and the wife has a 700, a 775, and an 800, his middle score is 750, hers was 775, so the lower of the 2 middle scores in that example would be his at the 750, and then for the approval process and to qualify for what the interest rate would be, they would use or utilize his credit score. CRAs have several responsibilities under the Fair Credit Reporting Act. The credit bureaus must maintain reasonable procedures to ensure the maximum possible accuracy of the information contained within the consumer's report. They must also provide the consumer with information about him or her in the agency's files and take steps to verify the accuracy of information disputed by a consumer. If negative information is removed as a result of a consumer dispute, it may not be reinserted without notifying the consumer in writing within 5 days. Okay? They must remove negative information 7 years after the date of the first delinquency, except for bankruptcies where it's 10 years and tax liens. And it says 7 years from the date that they are paid. Even though it says 10 years on bankruptcies and stuff, I have seen where most bankruptcies will actually drop off after the 7 years. So kind of bear that in mind. Credit repair solutions. The Fair Credit Reporting Act allows us to contact the credit bureaus directly to ensure that the content of the credit report is not inaccurate, misleading, incomplete, or unverifiable in any way. If the bureaus are unable to provide that an item is accurate or cannot complete their investigation in a time frame given by law, which is 30 days, they must strike the item from the report. Contrary to popular belief, consumers can dispute and validate information reported by the credit bureaus. Now, the credit reporting agencies don't make disputing information easy. They don't like to respond back quickly. It seems like they're always changing their phone numbers and changing their addresses, and it makes it difficult for the average Joe to dispute claims of negative information or inaccurate information on their credit report. That's why I always leave it to the professionals over at National Credit Care, and we'll provide you their information here in a minute. But they keep up on phone numbers and email addresses and addresses, and they're the what I would call the dispute kings, and they will make sure and get your client's information disputed, resolved, and cleaned up. What does FICO stand for? That's a very good question. Okay, the name FICO comes from the company's original name, the Fair Isaac Company. It was often shortened to FICO and finally became the company's official name several years ago. To create credit scores, they used information provided by one of the three major credit reporting agencies, Equifax, Experian, or TransUnion. But FICO itself is not a credit reporting agency. A FICO score is a credit score developed by FICO, a company that specializes in what's known as predictive analytics, which means they take information and analyze it to predict what's likely to happen. Basically, I remember when I first got into the mortgage business years ago, I asked somebody, well, what does that FICO score mean? And basically what I was told is, the higher that score is, the less likely somebody's going to file bankruptcy. The lower that score is, the more likely that they're going to file bankruptcy. And I go, well, how can they predict that? How does this actually work? And I was told that they would go in and they would analyze hundreds of thousands of records from particular individual buyers. And they would look to see what happened, what occurred 30 days before somebody filed bankruptcy, 60 days, 90 days, 6 months, a year. What was going on with, the bulk of people that led them to bankruptcy. So it was a lot of things. It was, all of a sudden they got 30 days late on one account. Then all of a sudden there was a collection item that showed up. Then all of a sudden there was a second collection item showed up. So when these things occur, it will drop the score. The lower that score, the more likely it is that they're going to file for bankruptcy. So Fair Isaac Corporation. FICO looks at a range of credit information and uses that to create scores that help lenders predict consumer behavior, such as how likely someone is to pay their bills on time or not, or whether they are able to handle a large credit line. Scores developed by FICO can also be used to forecast which accounts are most likely to end up included in bankruptcy or which ones will be most profitable, and credit-based insurance scores, which they have also created, are used to help insurance companies identify which customers are least likely to file claims. All right, so here's the types of things that credit reports are used for nowadays. Back when it first started, lenders were just using it. But now, insurance companies are pulling credit reports. Cell phone companies are pulling it. Employers are pulling credit reports. There's just about every entity in the world pulls your credit report. So if you want cheaper car insurance, keep your credit score high. If you want cheaper credit card interest rates and automobile loan rates and mortgage rates, keep your score high. If you don't want to have a deposit on your utility bills when you buy a house or you move, keep your score high. Everybody is looking at your credit score. So what is a good credit score? Well, there's actually dozens of FICO scores, with each version serving a different purpose. More on that later. Generally, the FICO scores range from 300 to 850, with the higher number representing less risk to the lender or the insured. Consumers with excellent FICO scores usually have a 760 score or higher, though every lender has different standards. They're likely to get the best rates when they're borrowing, as well as the best discounts on insurance. So what goes into a FICO score? So here are the components of what makes up your credit score. There's 5 main factors. The first one, and the one that it's weighed the most heavily, is your payment history. How well do you pay on time? And the credit reporting agencies don't track if you're 10 days late and you got hit up with a late charge. They don't track that. They track from 30, 60, and 90 days late is the primarily the way that they will track whether you're late or not. So if you're 29 days late and you make your payment, it'll never show up anywhere. But once you get to 30 days late, it's going to show up everywhere. So make sure that you're aware of and you educate your clients that they are paying within that 30-day time frame. Also, not every account is weighted the same. What I mean by that is, if somebody is running a little tight on money, like most people are right now with this virus situation, what I would tell people is pay your house payment first. If you get behind on that, it will have the most negative effect of any type of an account that you have. Then comes your secured accounts. In other words, your automobile loans or a second mortgage. The last thing that you would put on that would be credit cards, unsecured debt. So if you have an unsecured debt, I would let that one go before I stop making my house payment. Also, one thing that I wanted to share with the class today is there are a lot of companies out there offering some specialty programs right now because of the virus situation. I particularly own 2 pieces of property, one in Florida and one back in Indiana. I called my lender on the property here in Florida, and they were offering me a 3-month deferred program. Now, not every lender offers this, and not every lender's deferred program works the same, but let me give you an example. So I called my company, and they would let me skip 3 payments, and then those 3 payments were added on to the end of my account. So, you know, if I had a 30-year fixed rate mortgage, now it's 30 years and 3 months. They're not going to report me delinquent on the credit reporting agency. They're not going to hold it against me if I go to refinance later on. There's no late charges assessed, then there's no penalty to me. It's basically just a 3-month deferral program. I spoke with my nephew with his particular lender, and he had called up his lender and he had asked for a deferral as well. And they told him that, yeah, he could skip his next 3 payments, but in 4 months, he had to make up all 4 payments. So that wasn't really much of a benefit. So if you are suggesting that to clients, make sure that they're aware of the specifics for any deferral that they may ask for in, you know, today's environment. Anyway, getting back to the FICO score, so 35% of it is made up of payment history. 30% is the debt and the amount of money that you owe. That's also known as credit availability, which basically means, let's say you've got a credit card with a $1,000 credit limit. but you owe $950 on that, and you only have $50 of availability. So the availability on that particular account is very low. You don't have a lot of money available. So that actually drives your credit score down. That will actually hurt you. What helps you is if you have a $1,000 credit card limit and your balance is below 50% of the credit limit. There are basically two tiers. There's a 50% limit and a 30% limit. If you want to maximize your points on your credit reporting report, you want to keep it below 30% of the high credit, and that way you will maximize it. Some people think that their credit report is the same number, you know, forever, and that's not the case. Your credit score number actually gets adjusted on a daily basis. Anytime you take a cash advance or use your credit card and it increases the amount, that will have an effect on your credit score. If you make a payment and you lower the balance, that will have an effect. If you open up a new account, that's going to have an effect. So there's all these things going on a day-to-day basis that's going to affect your credit score. So you might have a credit score of 700 on a Monday, but on Tuesday you paid $1,000 down on a credit card and your availability increased. Now your score is going to end up going up. Now, it doesn't necessarily go up right away because most of the information going to the credit reporting agencies only occurs one time a month. So let's say, for example, Sears reports on the 15th of the month every month. So their information is then broadcast over to TransUnion, Equifax, and Experian on the 15th. Another company, they might do theirs on the 14th. Another company might do theirs on the 10th. Everybody is different, so that score is going to fluctuate. Age of the credit history, that represents 15%. So the older that an account is, the better it will be for you. New credit inquiries. You know, people say, hey, you know, if I pull my credit report, it's going to really affect me. Not really. It only represents 10% of the total score. The mix of the accounts, you know, how much credit cards do you have? How much secured loans do you have? How much in mortgage debt do you have? The mix of it also represents a little bit. So what's not in my FICO score? Now that we know what's in it, what's not in it? So employment information, including your salary, your occupation, your title, the name of your employer, employment date, employment history, where you live, the interest rates on your credit accounts doesn't show up. Child or family support obligations typically don't show up unless you're behind on them. Then the courts will put that on there. But if you owe child support and you're paying it on time, there is no record of that on your credit report. Soft inquiries, which are requests from you on your own credit report, will not have any effect on it. Any information that has not been proven to be predictive of future credit performance, such as race, religion, national origin, sex, marital status, age, none of that stuff has anything to do with a mathematical calculation of the algorithm, so none of it is included in on what they look at. Hope that makes sense to you guys. Is there just one FICO score? FICO actually has dozens of credit scoring models. Some are specific to what the consumer is applying for. For example, if you're applying for an automobile loan, your potential creditor may use a FICO score formulated that gives the significant weight to your history of making your car payment on time. Other models are customized for other types of clients. In other words, insurance companies, credit card companies, etc. Additionally, FICO updates its general formulas from time to time, with the most recent being FICO number 9, rollout in 2014. Paid collection accounts are not factored into FICO number 9 scores, and unpaid medical collections have less of a negative impact on credit scores compared to other credit scoring models in previous FICO algorithms. So it's just sort of like when they do updates to, you know, Internet Explorer. You know, there's Internet Explorer version 9, version 10.1, etc. The same thing is done with FICO scores. They do updates to each of the different types of models along the way. Now, here's the one thing that I found out is not every lender will update how they, which one of these FICOs that they use. So the most recent version is this FICO 9. Not every bank uses FICO 9. Some of them might use a previous version of it. Just wanted to keep that information in the loop to you guys. So coming in the summer of 2020, FICO Score 10 and FICO Score 10T are going to be coming out. The main difference for the FICO Score 10 versus 9 is that there will be a bigger gap between those with good credit and those with poor credit. FICO 8 was released in 2009 and FICO 9 was released in 2014. The most used FICO is FICO number 8. FICO Score 10 will weigh personal loans more heavily, penalizing borrowers who consolidate debt with personal loans and then choose to rack up more debt. So let me give you an example of that. You've got 5 or 6 credit cards and you're at your high credit on all of those accounts. And then you decide to get a loan to consolidate those 5 or 6 credit cards. And now those 5 or 6 credit cards have a zero balance and all of the credit availability, but you've got a personal loan for, let's say, $25,000. And then a year later, you end up still having that personal loan for the $25,000, but you went back out and you racked up all of your credit cards all over again. In this new scoring model, that's going to hurt you. All right, so be aware of that. So how do I improve my credit score? Here's the things that will have the main effect on it. Pay on time, that's going to have the biggest effect. That represents 35% of the total weighting of your credit score. Keeping your balances below 30% or less on your credit cards, that's the next thing that you want to do. Longer histories will lead to a higher credit score. The goal is to have a credit card for 25 years. Obviously, that's not going to be possible for somebody that's, 30 years old, but just wanted to keep the accuracy of the information to you guys as accurate as possible. Do not open any new credit lines. Have a good blend of different types of credit, car loans, mortgages, and credit cards. Inquiries and new credit. 4 points on your credit score per inquiry, and that's for the first 6 months. Whoops, hold on, didn't mean to do that. I need to go back one. So anytime somebody pulls your credit report, it's a 4-point hit to your credit report for the first 6 months. Then after 6 months, it reduces to a 2-point hit. And then after a year, it has no effect at all. So let's say you have a client with an 800 credit score. I pull their credit report. Now their score drops down to 796. And then 6 months later, it reduces down. Let's assume that everything stayed the same. They're still at a 796. But then at 6 months, time has elapsed. Now the 796 goes to 798. They pick the 2 points back up. And then 12 months later, it has no effect, and their score would go right back up to 800 again. So that's basically how that would work. All right. A lot of people ask me, well, what exactly can be removed? So here is a list of the items that National Credit Care has successfully gotten removed. And I've had more than just my son involved in enrolling at National Credit Care. I've had other family members that I've enrolled, and I've actually seen a lot of these items get removed off of people that I know personally. I've seen bankruptcies get removed off of credit reports. I've seen judgments get removed. I've seen collections. I've seen tax liens, lates. The easiest one to get removed is medical collections and basically any type of a collection. And a lot of lenders' guidelines, they don't really weigh too heavily on medical collections anyway. So that I don't typically worry about that, but those are the easiest ones to get removed. National Credit Care, because of the volume of business that we send them, they give me a really good deal on their services. Anybody that I send over, they get a discounted rate of $89 to enroll, and then it's $79 a month for every month that they're in the program. And then they send me a list monthly of the status of everybody, and they'll tell me, all right, you submitted this guy in to me 4 months ago. We've got this, this, and this removed. We've done a soft credit report full on him, and his score is now back up to 650. You can reach back out to them, update their application, and get them into a loan. So that's exactly what we do. I've had a lot of conversations with agents over the years that, you know, they run into somebody at a Little League game, at the library, out to eat at a restaurant or bar, and they get to talking to somebody, and they find out that you're a realtor, and they go, oh yeah, I'd really like to buy a house, but you know, I need to work on my credit. And as soon as I get my credit worked out, I'd love to give you a call and you can help me out. The problem with that is I've heard that statement told to me personally probably over 1,000 times, but then when I ask that person point blank, you know, well, what exactly are you doing to correct your credit shortcomings? I've only had one person that had given me an answer that was even close to being accurate, okay? Most people don't know what to do to fix their credit. It can be overwhelming, time-consuming, irritating. I mean, it just gets under your skin. That's why I always like to leave it to the professionals. But these people that in the past, you know, you would hear that come out of their mouth, yeah, I've got a 400 credit score, I've got a 500 credit score. Most of the time, most of my agents would just, you know, shake their hand and try to get away from them as fast as they could. What I want you to do from this point forward is give them their card, give them your card, have them reach out to me, get them in touch with me or somebody on my team. We'll take a complete thorough application on them, pull the credit report, and then we'll get them enrolled in this program. And then once they get cleaned up, we return them back to the agent that sent them to us to begin with every single time. And these are basically free leads to you. And it's, you know, a lead that all of a sudden just drops into your lap and you weren't expecting it. Now, oh, I just got a call from Chris. This guy that I forgot about that I sent him 6 months ago, they got him cleaned up. He's got a 650 credit score, and now we can get him into a deal. So we want to make sure that we are giving these people the opportunity to get cleaned up. One of the worst things that you can do as a realtor is give people advice on paying off collections, because typically what happens if you tell somebody to pay off a collection account is basically their credit score will get worse. Instead, let them talk to a professional, either somebody on my team or somebody at National Credit Care, and let us analyze it and figure out a solid game plan to get them fixed. Most people, it seems like that I review their credit that have collections on there. Let's say they have 5 or 6 collections, and most of them are medical, and maybe that the total of those 5 or 6 is $10,000. If they sign up with National Credit Care, on average, it's going to take them less than 6 months to clean up that situation on their credit. So you can do the math, knowing that it's $79 to enroll, $69 a month for every month after that. You know, it's less than $500 in expense to dispute and get them removed like they never even happened, rather than advising your client to slough out $10,000 and their scores drop. We don't want to do that. Okay, so what's the difference between credit score boosting and credit repair? All right, so credit score boosting is something that we do in-house. We do it for free, and our company pays that expense. So as we read through this summary real quick, credit score boosting is primarily a way to manipulate a buyer's credit score by adjusting the balances on their credit card debt. Having a balance at 50% or 30% or 20% of the credit limit will help improve a score. This process is typically done within 5 business days. The buyer must pay down the account and then request a letter from the creditor that is reporting the account, and it must be on a company letterhead, and the name on it must match what's on the credit file. In other words, the client's name. The letter must include the company's address, telephone number, the last four digits of the account number or the full account number, and the date after the date that all this information was changed. And then I submit this stuff into my credit reporting rep, and he does what is known as a rapid rescore, and I can get that done within 3 to 5 days. And this rapid rescoring, just so you guys know how much this costs, let's say that we're disputing a visa for a client, that they're disputing a 30-day delinquency. But we're going to dispute it at TransUnion, and we're going to dispute it at Experian. So it's one account at 2 bureaus. So that costs me $100 per account per trade line. So if it's one account at 2 bureaus, it costs us $200 to get that done. But we have been very successful when it comes time for credit score boosting and manipulating the balances on your buyer's accounts to getting their score up so that we can then get them either approved or B, get them into a little bit better interest rate. Okay, credit repair. Credit repair is more of what I call heavy lifting. If you have a client with multiple collections, slow payment history, repossessions, charge-offs, foreclosures, bankruptcies, we can't boost bad credit. Instead, we get disputes going on it, and we get it removed from their credit report. For this kind of work, I refer this type of business to an outside third-party vendor, which I've mentioned numerous times today, National Credit Care, and they do an excellent job of educating and enrolling these people into this process. Now, here's the other thing that they do. Not only do we want to remove the negative accounts, but we also want to add some positive trade lines. So this company also will help your clients get some new credit added onto the credit file. So they know which companies, which visas, and which MasterCards have the most relaxed guidelines and would approve somebody that would be, enrolled in this type of program. Now, if they can't get them enrolled in that type of program, the other thing that they do is that they have some companies that offer secured credit cards, which will also help boost a credit score. Now, one of the things that I want you guys to be aware of when we go and we do a secured credit card, and myself as a lender are reviewing somebody's credit report, there's no way for me to tell as a lender which accounts are secured credit cards and which ones aren't. So because of that, there is no differentiation. We can manipulate somebody's credit score by adding a secured card. Let's say that we give them a $300 deposit and they give them a $300 credit limit and it's got a zero balance on it. They go off of the percentage, not the actual dollar amount. So what I mean when I say that is if you've got a $300 credit card limit and a $10,000 credit card limit, they're looking at the percentages of that, not the dollar amounts. So if you've got a $10,000 credit card with zero balance, that's going to help you just as much as a $300 credit limit with a zero balance. So bear that in mind as well. Recommendations. If people are saying, hey, what are some things that I can do to make sure that I keep up good credit? Here's some things that you can be educating your buyers with. Number one, keep up with all their current debt. And the reason that I make this number one is the number one thing about your credit score is your payment history. So if that represents 35% of your FICO score. So keep up with your credit. One of the other things I mention this for is I've had people that we've gotten pre-approved and then they still needed to save up some additional money for the down payment and the closing costs. And they decided that the smart move was, well, since they were already pre-approved, they were going to stop making their car payment, and the $600 a month that they were using for their car payment, they were going to save that money and use that for the down payment and closing costs. Bad move, terrible mistake. all right, because, what happens is, we get somebody pre-approved, and then a couple of days before closing, the underwriter will spot check, and not every single time, but probably the majority of the time, they'll do a new credit report pull to verify that there's been no new debt added and that everything is as it was at the time of pre-approval. Number 2, do not pay collections. I never tell anybody to pay a collection account because initially it's going to drive your score down. Instead, I'm going to tell you to dispute it and try to get it removed. We want to add positive trade lines. You can do that by getting a credit card, getting a secured credit card. Number 4, jump on another person's credit as an authorized user. When my son was trying to get into his particular property 18 months ago, I let him jump on one of my credit cards. And the type of credit card that you want to allow somebody to jump on is one that has a lot of credit availability. In other words, it's got a $10,000 limit, you don't owe anything on it. And also that the account's been open for a long time. They said that the goal was to have an account for 25 years. If you had your choice between a card that you've had 3 years and a card that's 10 years old, you'd want that person to jump on the one that's a 10-year-old because that'll have a more positive effect. Pay down on your credit card balances, number 5 there. Number 6, keep up on student loan payments. Here's the thing to remember about student loan payments. Most people go to school for 4 years, and there's 2 semesters each year, and so they're getting 1 or 2 loans for each semester. All right, so if you're going to school for 4 years, that's a total of 8, and if you're getting 2 loans per semester, that's a total of 16 different loans. Now, the student, they'll get a statement where everything is showing as consolidated with 1 monthly payment and 1 total balance. But the truth of the matter, what I see on my end is all 16 of those loans. So if somebody that has student loans decides not to pay, it gets delinquent on all 16 of those accounts, which is really going to have an effect on the credit score. So make sure that you stay up on those student loans. Don't refinance a car payment while trying to purchase a home. All right, we don't want any red flags to pop up. As of July 1st, 2017, tax liens and judgments won't show unless a 4-point verification is done. And what I mean by a 4-point verification is they have to verify that that tax lien is that particular person, so they're going to verify the name. Then they are going to have to verify maybe a social security number. Then they're going to have to verify maybe the account number. Then maybe they're going to have to verify the address. Well, the credit bureaus don't like to do all that type of work. So unless that information falls into their lap, a lot of these tax liens and judgments now are not even showing up on the credit report. So bear that in mind. All right, so in conclusion, I've been told on many occasions throughout my life that your number 1 asset is your ability to earn money. All right, and I've been told that many, many times over the course of my lifetime. Somewhere close behind that is your credit score because it looks at so many different aspects of your life. When you go to get a mortgage, they're looking at your credit score. Credit cards, they're looking at your credit score. Personal loans, insurance, employment, utilities, your cell phone bill. So everybody is looking at your credit score. So when you are having conversations with people, yeah, your number 1 asset is your ability to earn money, but a close second behind that is your credit score. So make sure that you're educating clients to get with someone like myself 6 months ahead of time. They can go to freecreditreport.com and get a copy of their credit report for free one time a year. Review it. If there is any discrepancies on there, reach out to me and I'll guide you in a direction to try to get those things removed because it can have such a big effect on every aspect of your life. Now, that's pretty much it on this particular presentation. If anybody has any questions, down here at the bottom of the screen is my cell number and my email address. If you've got any clients right now that are in your CRM, I would send out a mass email to everybody that you know, that if they do have any credit-related issues, that right now is probably the best time in my lifetime to dispute any negative or derogatory trade line, and have them reach out directly to me, and we will try to get them all cleaned up, because right now, on average, prior to the virus, it was taking on average 6 months or so to get somebody cleaned up. But now, in today's environment, I'm guessing it's going to be closer to 90 days. So if you have anybody that you need to reach out to help them get cleaned up, right now is the perfect time to get that done. I want to thank everybody for coming in and attending the class today. If you have any questions, feel free to give me a call. It's been a pleasure speaking with you. Thank you.
Thanks, Chris. See you later.